Hi, everybody. I'm Bob Marone for Westchester Talk Radio. And once again, we are with our friends at Hightower Westchester. And with us today, we have Roman Ciosek, who's the managing director and partner at Hightower Westchester. Today, we will be speaking about Roth conversions, how they work, as well as the pros and cons of converting. Roman, could you walk us through some of the benefits of this strategy?
Sure, Bob. Hey, Bob. Nice to see you as always, but thank you
Same
for
here.
having us on. So this whole Roth and Roth conversion has been a tremendous topic for many years now. For us in our business and for our clients, it creates a significant amount of opportunity. It's a powerful strategy if utilized appropriately. So let me kind of explain how it works and what it pertains to. For the way we look at this is something that you could apply to your retirement accounts, such as your traditional IRA, your SEP, or your simplified employee pension plan, and potentially your 401k plan as well. So the idea or the concept really is to pay the taxes up front on the money that's pre-tax, and then when you take the money out during retirement, you're paying no tax. So you're forward funding the tax liability. That's ultimately what you're doing in this particular case. So let me just kind of provide an example as how we look at this. If somebody has an IRA that's worth $100,000, and if they want to convert this into a Roth IRA, so again, pre-tax dollars that you've gotten deductions for throughout, let's just call it 10 years, and at your age 50, now you want to convert these funds to a Roth, well, you have that flexibility to do that. So what you have to then do is pay taxes on that $100,000 that's pre-tax. So in this particular case, if I want to convert my $100,000 IRA, traditional that is, into a Roth, well, if I'm, let's assume in a 20% federal or whatever, the total tax bracket, I need to pay this year $20,000 in taxes.
Yeah.
So now I have this $100,000 and I have this liability of paying $20,000. What I really want to do is take that $20,000, most likely from my cash account, my personal account, and pay the taxes on that. And then you take the $100,000 that's the traditional IRA and you flip that over or convert it into a Roth. So now you have a $100,000 Roth, still it's in its integrity, and then you've already paid the $20,000 in taxes. Now this $100,000, this bucket now grows completely federal and state tax free. So fast forward, I'm age 50. Age 60, let's say this grows to $180,000. Well, now that $80,000 plus that principal of $100,000, whenever I want to take this funds out after age 59 and a half, is completely tax free, right? I could touch the principal prior to that, but for purposes of this, let's just sort of elaborate on that. I could take those funds completely tax free. Now, a couple of other benefits around it is that there are no required minimum distributions on this, unlike a traditional IRA. So you bypass or forego this whole idea of RMDs. Again, creates more flexibility. And the other part of it is and we've used this as a strategy, is that it affords you the ability to transfer tax-free funds to your beneficiaries. Now, if my spouse, if I die tomorrow and this funds go to my spouse, she could take this upon her life again. But for my kids, let's just say they're getting this $180,000 split between the two of them, $90,000 each. They could then take those as beneficiary Roth IRAs and take them based upon a 10-year time frame. Now, again, that's changed a little bit with the Secure Act. Prior to that, they could have taken it out based upon their life expectancy, but now they have to withdraw the funds over a 10-year time frame. So again, imagine how impactful, if I convert age 50 and now I have a 30, 40-year run rate on these funds, it's a significant savings, and it takes away the variable of unknowing what the tax situation may look like from the tax code standpoint and also on a personal level.
Roman, is age a factor when considering this strategy?
Yeah, it's we always have this debate, and we sort of do a significant amount of research around it as to when and how it pertains. Like, people are living longer, so there is a qualitative and a quantitative aspect to this when we're assessing or looking at this from a modeling standpoint. So we factor in a lot of different things. If somebody's parents are alive in their 90s, it makes it all that much more palpable to do it, whether at a certain age or at a later date. We generally look at it at age 50, sort of as kind of a baseline. But again, there are circumstances. We've had clients that are in their 30s and 40s that had traditional IRAs where they wanted to convert money because they understand the implication of that overall. So it certainly plays into it. And they do obviously see the benefit of the tax-free income.
Wow. Is the strategy more attractive to do this year?
So this year, it can make sense, and this is something that for us we're assessing it for certain individuals because as markets are down, as we all know, year to date, and it can make sense. So again, let's use the same example of $100,000 traditional IRA. Let's assume you're down 10% on the account. Now it's worth $90,000. Well, in the same example that I had before, you were paying $20,000 if you're in a 20% bracket on those taxes on those funds to convert. Well, now you're paying $18,000, so you're paying less with the potential of larger upside on those funds too because they're down. So this year, because markets are down, it clearly can make a bit more sense to start looking at these assets.
If someone does this, are they converting everything into their Roth?
So, for us, this is a conversation that we have with our tax advisor as well, because as much as it seems relatively simplistic, there are a lot of moving parts as to which assets, how much can you take, et cetera. The one part that, somebody comes to us and they get overly excited around, hey, I have $1 million IRA, let's convert all of it all at once into this strategy. And yeah, it potentially can make sense, but there are other variables in here. Is that you're going to put yourself in a higher income tax bracket immediately if you convert $1 million, right? You're going to have $1 million of taxable income. So, what we emphasize to our clients is the ability to spread this out, maybe from a 3 to 5 year standpoint, and just look at this as a longer term form of a strategy. So again, it's case by case. But we try to really coordinate with our tax advisor and make sure it makes sense from a longer term standpoint.
So when referring to taxes, is this strategy more beneficial than if you're in a higher tax bracket when you retire?
Yeah, taxes, like anything and everything, play into this overall strategy. And it's important to think about it overall. Ultimately, you really want to have the ability to pay less taxes on your earnings in the future. And converting to a Roth is one way to reducing your future tax liabilities. People always think that they will be in a lower income tax bracket when they do retire, which clearly is not always the case. Many of our clients tend to be in a higher income tax bracket. So even when they do retire, because they have an investment account that's generating income, they have interest, dividends, capital gains, Social Security, pension plans, potentially, and additional RMDs, the pre-tax retirement account, which may ultimately put them into a higher tax bracket. So this strategy is even more effective if someone thinks that they will be in a higher income tax bracket when they do retire, because taking withdrawals from a Roth IRA are completely tax-free.
I guess the unknown variables are not only what your tax bracket is today, but what you project it to be in the future.
Yeah, no, absolutely, and that's a valid point. If we could predict that, it would make all our lives, I think, a little bit easier.
Mm-hmm.
But we always try to kind of, when somebody comes to us, when we sit down with them, what we try to do is sort of mitigate that tax risk. How do we figure that part of it out? And the one thing that we know is that we're not going to know exactly what your overall tax bracket will look like when you retire, and we don't know what the federal or capital gain taxes, ordinary income taxes will look like, right? That's the big unknown. So what we sort of try to emphasize to our clients is, in the ideal world, if you were 25, 30 years old, or if you're starting out to building out your nest egg, what you want to have are 3 types of buckets, right? You want to have the pre-tax buckets, such as the IRA or 401k plan, where you're putting money in pre-tax. Number 2 is you want to have an investment account, right? Joint account, you and your wife or your spouse, and you basically have the ability to take money out. There could be offset against losses. You have capital gains, capital gains, interest, dividends, ordinary income in there as well, potentially. So then the third part is having the ability to have a Roth, right? That's the third bucket, which is tax-free income. So now somebody's retired, say 65, 70 years old, and they come to us. It simplifies our life to give them the cash flow that they need, because we could pull certain levers based upon what specific tax bracket they're in and what specific brackets are within sort of the overall Fed brackets, if you will, right? So or income brackets. So it gives us flexibility, because to us it's helping them get to a point where they're ultimately minimizing taxes.
How about the concept of a so-called backdoor IRA conversion?
Yeah, there's been a lot of talk, and I don't want to say controversy, not the right word, but there's been a lot of debate around whether this is a viable strategy or not. Legislation, let's just say, they've been trying to sort of stop this loophole, but ultimately what it is, because what the higher income individuals, they're not allowed to make contributions into a Roth. So this is a way for them to make a contribution into a traditional IRA. Okay, whether it's a deduction or not, that's based upon our tax advisor. And then immediately, once they make a contribution into their traditional IRA, they then convert that immediately into a Roth, making sure there's no income or interest that has hit the account. And now they have then created this Roth opportunity. Again, I preface this because this is something that they need to run by their tax advisor to make sure the strategy makes sense. But clearly, it's one way of bypassing, or at least having the ability to create a Roth if your income limits are significant.
It's interesting. Anything else that you would like to add, Roman?
So, for us, again, it's having a holistic picture. It's looking at all of the pieces of the puzzle and really creating that longer term roadmap. As I think as Bob, for us, it's about really like bringing in the entire team together and looking from your tax advisor standpoint, coordinating these strategies with your estate attorney, and making sure these are longer term viable strategies. As circumstances change, tax situations change, tax codes, etc. But it's ultimately creating a customized solution for each of our clients.
Thank you, Roman Ciosek, Managing Director and Partner at Hightower Westchester. Thank you very, very much for your time.
Thank you, Bob. It's always a pleasure.
The pleasure's mine, sir.
Take care.
HighTower Westchester is a group of investment professionals registered with HighTower Securities, LLC, member FINRA and SIPC, and with HighTower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities, LLC. Advisory services are offered through HighTower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. HighTower Westchester and HighTower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of HighTower Westchester and do not represent those of HighTower Advisors, LLC, or any of its affiliates. HighTower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.